Welcome to The Explainer. Today, we're slipping right into the shoes of a sell-side equity analyst to run a strict data-backed valuation on Ligand Pharmaceuticals, ticker symbol LGND. We've got a fresh data dump of their financials, and we're going to build a fundamental valuation from the ground up. If you're the type who loves tearing apart balance sheets to find the real intrinsic value hiding behind the market hype, well, you're in exactly the right place.
Let's take a quick look at the agenda. We'll be running through Ligand's high-level overview, doing an absolute valuation with a DCF model, touching on excluded models, diving into relative valuation and multiples, looking at asset-based metrics, and then wrapping it all up with our final intrinsic value synthesis. All right, let's establish our baseline. As of the latest data poll, Ligand is trading at a pretty robust market price, $232.30. At that price tag, the market is slapping a massive $4.65 billion valuation on the company. So, that's the current reality out there on the trading floor. But here's where things get wild. When we crunch the absolute fundamental numbers straight from the source data, the model spits out a fair value price of exactly $90.40. I mean, let that sink in. The market is happily paying over $230 for an asset that our strict cash flow metrics say is barely worth $90. And that right there is the core tension of our whole analysis today. That huge gap gives us a staggering negative 156.96% margin of safety. Now, if you're an equity analyst, a negative margin of safety that deep is like a 5-alarm fire. It perfectly sets the stage for a massive showdown between the super bullish market sentiment and the icy cold reality of intrinsic value. Section 1, Ligand's high-level overview. Let's pop the hood and see exactly what's driving this multi-billion-dollar market cap. Looking at the trailing 12-month numbers, the top line actually looks solid. We've got revenues sitting at roughly $268 million, with an impressive net income of over $124 million. But putting on our sell-side hats for a second, look at the conversion. Only $48.9 million of that translates into actual free cash flow. Plus, the earnings per share compound annual growth rate over the trailing 12 months is a blistering 232%. So on paper, immense profitability. In reality, a pretty noticeable bottleneck when it comes to actual cash generation. And to make our lives even harder, forecasting this equity is incredibly tricky because the growth is just wildly volatile. Just look at the disparity here. The net income compounding growth rate was a very respectable 78% over a 3-year average. But look at the trailing 12 months. It absolutely skyrocketed to 3,021%. When you see a growth spike that aggressive, you've got to be extremely cautious projecting future earnings. You've got to ask, is this a one-time windfall, or did they actually just establish a crazy new baseline? Section 2, Absolute Valuation, DCF Model. Let's move into our first formal methodology. We're tackling the absolute valuation, using the gold standard, the discounted cash flow approach. Here's how we build it out based on the data. First, we extract that unlevered free cash flow of $48.9 million. Now, because exact discount rates and cost of capital metrics weren't explicitly handed to us in the raw docs, we systematically bridge that cash flow using sensible default assumptions. We apply a standard assumed weighted average cost of capital, or WACC, and figure a mature terminal growth rate of maybe 2 to 3% to project out 5 to 10 years. When we run those steps on the DCF metrics, the model directly outputs a fair value of $90.40. Interestingly, the source data also points to a secondary EPS-based fair value of $88.30, which practically mirrors our cash flow model. This just confirms the massive gulf between cash flow reality and the ticker price. The underlying math simply does not support a $230 valuation based on what the business is generating right now. Section 3, Excluded Models and Limitations. Now, before we jump into the relative metrics, we have to practice some radical transparency. As analysts, we have to call out what data we don't have. First, we're entirely skipping the dividend discount model, simply because there's zero dividend history here. We're also skipping a sum of the parts valuation because the provided filings lack distinct segment data. As for the adjusted present value model, bypassed. Ligand has a highly stable debt-to-equity ratio of 0.44, making a standard WACC perfectly sufficient. And finally, the residual income model is kind of sidelined here. Because of that massive 3,000% spike in net income we just talked about, calculating a stable future equity charge is just too unreliable. Section 4, Relative Valuation and Multiples. Okay, since our absolute valuation is painting a pretty bearish picture, let's pivot. Let's see how Ligand is priced relative to the market and its own history. The documents don't hand us a specific peer group, so we're benchmarking against historical averages. Right now, Ligand is trading at an elevated PE of 39.51, which is way up from its trailing average of 27.56. Its enterprise value to EBITDA is sitting at a towering 53.94, and its price to sales is practically in orbit at 17.36. Across the board, these multiples are massive premiums over the company's own historical baselines. Basically, the market is pricing in absolute perfection.
Section 5. Asset-based valuation metrics. Next up, we need to look at downside protection. If this whole growth story falls apart, what's the actual bedrock of this company? We figure this out by looking at balance sheet strength via asset-based metrics. When you put an enterprise value to assets ratio of 2.80 up against a price-to-book ratio of 4.52, a very clear picture emerges. The market is paying roughly 4.5 times the stated book value of the equity. This means investors are heavily valuing Ligand on its future intangible operations and pipeline potential, rather than its restated net asset value today. But hey, it's not all doom and gloom. Here is some incredibly good news for the bulls. Even with those sky-high multiples, Ligand's liquidation profile is virtually bulletproof in the near term. They boast an astronomical current ratio of 22.23 and a quick ratio of 21.98. To put that into perspective, they have over 22 times the liquid assets needed to cover their short-term liabilities. This is a literal fortress balance sheet. So, immediate bankruptcy or liquidity risk? Effectively zero. Section 6. Final intrinsic value synthesis. All right, it's time to bring it all together and deliver a final synthesis on this equity. We've dug into the cash flows, tracked the historical multiples, and pressure-tested the balance sheet. Our final takeaway? Well, while that balance sheet is exceptionally liquid and safe, the current market price relies on terminal growth rates way beyond what our traditional DCF and relative multiples can mathematically support right now. I mean, when your free cash flow dictates a $90 stock, but you're trading at $232, management's margin for error is exactly zero.
Which brings us to our final thought. The numbers don't lie, sure, but they also don't have a crystal ball. So the crucial question you've got to ask yourself as an investor reviewing this ledger is this: what massive future catalyst is the broader market seeing that our fundamental cash flow models are currently totally blind to? Is there some unannounced, game-changing breakthrough waiting in the wings, or are investors simply caught up in a highly dangerous 156% overvaluation trap? Thanks so much for joining me for this explainer, and I'll catch you in the next one.